This video will break down exactly what a market reversal really is, share a powerful 3-step confirmation formula, look at real chart examples, and go over mistakes to avoid. We are big on engagement here, so let me know in the comment if you've ever been fooled by a fake reversal. But before we begin, please subscribe to fxpage, smash that like button, and join our free Telegram channel for trading signals and updates. Ready? Let's dive in. What a reversal really is. A trend is simply a series of higher highs and higher lows for an uptrend, or lower lows and lower highs for a downtrend. A trend reversal means the market is shifting from an uptrend to a downtrend, or vice versa. In other words, buyers lose control and sellers take over, or the other way around. So, what does a real reversal look like? It's more than just one big candle moving the other way. Think of price action like a wave. In an uptrend, price matches up step by step. In a reversal, price starts making those higher highs and higher lows and start breaking the structure. For example, in an uptrend, if price finally breaks below the last swing low, that's often the first clue the uptrend might be ending. The market structure has shifted from higher lows to lower lows. It is important to distinguish a true reversal from a mere pullback or correction. In a pullback, the previous trend structure generally holds. The trend swing higher highs in an uptrend are intact. A real reversal breaks the structure. In a downtrend reversal, price will break above the last swing high. Always remember, the market is right, and waiting for a structure break keeps you on the right side of the trend. Imagine price in a downtrend suddenly makes a series of higher highs and higher lows, breaking the prior downtrend. Next, we will learn how to catch exactly that moment with a simple formula. I will show you a 3-step formula that makes reversal confirmation simple and effective. 3-step price action confirmation formula. Now, let's break reversal confirmation into clear 3-step process. Think of this as your checklist to confirm a trend change. We will use only price action rules, no moving averages or oscillator. Step 1. Identify the existing trend and key swing points. Start by spotting the trend. Is price making higher highs and higher lows uptrend, or lower lows and lower highs downtrend? Mark the significant swing high and swing low that defines this trend. These swing points form your support and resistance. In an uptrend, focus on the last swing low, which is the support. In a downtrend, note the last swing high, which is the resistance. Step 2. Wait for a break of market structure. This is the first sign the trend might be changing. In an uptrend, watch for a break below the last swing low. Price closes beneath it. In a downtrend, look for a break above the last swing high. A candle closing beyond these swing points means market structure is broken. This isn't a guarantee reversal yet, but is a strong hint that the old trend is losing control. Step 3. confirmed with a reversal candle signal. After the structure break, look for a clear price action signal to confirm the move. For example, if we broke support, a bearish pin bar, engulfing candle or inside bar after a retest can seal the dip. In an uptrend reversal, a bearish pin bar at new resistance or a double top pattern at that swing might appear. In a downtrend, a bullish engulfing or hammer at support often forms. It is ideal if price retests the broken level and this produces the reversal candle, confirming the shift in supply or demand. By following these 3 steps, mark the swing, see the break, then wait for the candlesticks. You avoid jumping the gun. You only trade once the market itself has given the confirmation. Next, I will put this formula to work on real charts so you can see exactly how it looks in action. Real chart example. On this dollar-yen daily chart, price was in a clear downtrend, step 1, as shown by the lower highs and lower lows. Notice the horizontal line marking the last swing high. Then price broke above the swing high. Step 2, break of structure. After the break, price retested that level and formed a bullish inside bar reversal. Step 3, the inside bar highlighted. The breakout from the inside bar was strong and price surged up sharply, confirming the reversal. Let's look at another example. On this GBP daily chart, price was trending up by forming higher highs. We have a key resistance area where price made 2 peaks. On the second peak, we got a big bearish pin bar. That's our reversal signal. Right after, price broke below the last swing low, which is the structure break, and a strong downtrend followed. This perfectly matches our 3-step formula. Structure break plus reversal candle signal the new downtrend. This example show why waiting for all 3 steps pay off. You can clearly see how first breakouts were filtered out and only the true reversal moves were taken. When you practice this, you will start recognizing these setups on your own charts. Think about it. Have you seen a chart like this before? Drop a comment below if you have questions or examples of reversal trades. I'd love to hear from you. Mistakes to avoid. Even pro traders have made mistakes when trying to catch reversals. Here are the biggest pitfalls to avoid. Acting too early, no structure break. A common error is trading as soon as you sense a reversal without waiting for price to break the critical swing point. If you skip that break, you risk trading a mere retracement. Always insist on a candle close beyond the swing before calling it a reversal. Ignoring the bigger trend context. Trying to pick a top or bottom in a very strong trend can backfire. If the higher time frame trend is strong, many pullbacks will look like reversal until they are not. Be aware of the bigger trend. Confirmation is much more reliable after price counter the main trend. Misreading candlestick signals. Not all candlestick patterns guarantee a reversal. For instance, an inside bar doesn't always mean reversal. it can signal continuation. A double top or double bottom pattern needs each support or resistance level to break first. Only trust signals at significant levels or swing points, skipping stop loss or risk management. Even with a great reversal signal, the market can surprise you. Always place your stop beyond the recent swing high or swing low. Avoid going all in without planning your risk. Smart traders define risk first, then look for reward. Overtrading on lower time frames. Reversal signals can appear on any time frame, but the lower the time frame, the much false signal you will see. Beginners especially fall into this trap. Stick to higher time frames, daily or 4-hour time frame for trend contest, or at least confirm with multiple time frames. By avoiding these mistakes, you ensure you only enter high probability reversal trades. Now, you know exactly how to confirm a trend reversal using only price action. Remember the formula: identify the trend and swing levels, wait for the structure break, then look for a strong reversal candle. This disciplined approach keeps you trading with the market, not against it. If you found this tutorial helpful, please like, subscribe, and share it to help others. I post new trade tips regularly on fxpage, so hit the subscribe button and ring the bell for notification. Also, don't forget to join our Telegram channel for free signal and analysis. Link in the description. Thanks for watching. Let me know in the comment which reversal signal is your favorite to trade. See you in the next video.